This is Andrew Comstock, President and Chief Investment Officer of Castlebar Asset Management. Today we're going to go over our market review and outlook for the calendar year of 2016 and looking into 2017. Here's kind of our agenda for today. We're going to review the market activity for stocks, bonds, commodities, look at economic data. We're going to cover some local Kansas City area companies, talk about their performance and what's gone on for today, and then we'll get into our outlook for next year. The themes for 2016 are pretty broad and pretty diverse. More or less, we're going to look back at 2016 and think this is the year that polls and pundits got it wrong. When we look at the Brexit vote and when we look at the presidential election, these are things that were very predicted to go in one manner and ended up in a very different direction. And the outcome was significantly different than any had anticipated. And the markets reacted pretty strongly in directions that may not have been what we had expected. This is also the year that we saw a bottom in energy prices. In February of this year, we saw energies rebound off of a low, hopefully a generational low, but at this point, it marks the low for this cycle. Interest rates have been on the rise. We saw interest rates, at least when we look at the 10-year Treasury bond, kind of peak at a low point of 1.37% this July, and they've kind of rallied steadily since then. This is also a year where we saw the dollar continue to strengthen, and kind of its rally for the past few years continues to be pretty robust. Economic growth is now in a stable position. Again, we're probably below the 3% trend growth that everybody would like, but we've kind of settled in at approximately 2 to 2.5% growth, at least at the current time. International markets, at least for U.S.-based investors, have been a difficult situation, primarily because of Europe. Certain markets like Canada and Japan have had a pretty good year, and we'll discuss that here later. Corporate earnings are back. We went through about a 5-quarter recession in corporate earnings, and in the third quarter of 2016, we saw earnings return to growth again, with about a modest growth rate of 3 to 5%. And then this is kind of a question that we say is, has optimism returns? Since the election, I know from our clients and from talking to other people out there, there seems to be a more optimistic tone for some in the business community. Others, I think, who maybe the election didn't swing particularly the way they'd like it, maybe they also are looking at things a bit differently. So, but we have seen some optimism return, at least from some of the business owners we work with and we've talked with. So here's a brief market overview of what's kind of gone on this year. We'll mainly focus on the 5 and 10-year average annualized return here. We'll get to the year-to-date here in a second. You can kind of see in the 5-year annualized rate of return that the S&P 500, pretty much everything on the column there, S&P, Dow, NASDAQ, Russell, and mid-cap stocks, are all looking at pretty much 10% gains or better. The Dow is the only one just kind of below that. That generally is above the trend that we have seen in the past. We like to see approximately 8 or 9% annual rates of return from the markets, and so that's an above trend move. But if you look at the 10-year returns, those are all pretty much below trend. The only one kind of above that 8% threshold is the NASDAQ. On year to date, this is kind of just a chart year to date through December 2nd. You can kind of see the Russell 2000s up close to 16%, and most of that run has happened since the election. The NASDAQ's up about 5, the S&P 500 is up about 7.25, and the Dow is up about 10%. On a long-term chart of the S&P 500, we still frequently talk to people who say their investments have not recovered or their 401k has not recovered since the financial crisis. You can clearly see that we are up, close to 42% or even a little more than that above where we were in the peak of 2007. So we've definitely moved on from that, and you can see that we are at new, fresh, all-time highs here. A quick year in review, if you had to look at a chart and kind of go through and point out a few of the milestones throughout the year, I think you'd have to first start off and remember where we were back in January and February, and that was the markets looked pretty bleak. We saw stocks sell off about 10.5% right out of the gates, and it was a pretty relentless sell-off, and that was particularly tied to the energy markets. Stocks and energy, or particularly oil prices, were very highly correlated, and we saw a bottom in February of crude prices, and that also marked the bottom in the market for the year. Throughout most of the spring, we saw the Federal Reserve put themselves kind of in a holding pattern, and this signaled for a couple of things. Is that one, we were going to remain lower for longer, or at least for a little while longer, in terms of our interest rates that the Fed sets. This also signaled to us that they were going to remain probably on the sideline for a good chunk of this year. There was a window maybe in September where they could act, but the Fed tends to not want to insert itself into the political environment in any way possible. And so you saw the market kind of steadily rally between that and energy prices. Obviously, the big thing this summer was the Brexit vote in the UK. The UK decided to leave, or through a referendum, that they would exit the European Union. And this is a pretty unprecedented move. The only other country to do this was Greenland, and that's a different beast than the United Kingdom. There was a pretty swift sell-off, at least here domestically. We saw a sell-off around the world as well. But there was a pretty quick recovery. I mean, most of the losses from the Brexit were recovered within about a week, which was very surprising to us. The losses for the pound and also for the UK market haven't quite recovered yet, and we'll talk more about that in the international section. Throughout most of the fall, we saw a lot of M&A activity. And with the Fed being on hold and the expectations that there would be a Clinton presidential win, we saw stocks kind of tread sideways. But October was a particularly big month for mergers and acquisitions, at least being announced, highlighted by the Time Warner AT&T deal. And then we had the election day in early November, and you can see the markets are higher since then. The reaction since the election, the S&P 500, at least until Friday, December 2nd, was up about 2.5%. What were the big winners? Well, that financials, industrials, and materials all saw a pretty good outperformance since the election. Financials primarily because interest rates have moved steadily higher since the election, and the appearance that there probably could be a little less regulation on that section. And to be honest, financials have just underperformed for a period of time. So there's a little bit of catch up going on there. Industrials, materials, I think the thought or the thesis there is that there's going to be a pretty big infrastructure spending here, and that the business environment is going to expand. Industrials were also tied to the energy market here. Many of the large industrials in this country have reoriented their business to benefit from some of the growing energy infrastructure and energy jobs that have kind of been around or been developed over the past decade or so. So they've obviously thrived since the election. What struggled? Utilities have struggled. They've been the worst. They're a very interest rate sensitive stock typically. What you've seen is investors pouring utilities for the yield over the past several years, and with interest rates correcting a little bit, becoming a little higher, the need for them is a little less, and also they issue a lot of debt to pay for their big projects, and so it's a little more expensive for them to operate. Consumer staples also have not performed well since the election. A couple of reasons there. It's been a bit of a safety trade. Their valuations have been a little rich, and they tend to be multinational companies. And we know that there seems to be a theme of multinational companies are going to be put on watch by the new administration. And so we'll see what happens with that. So how did we get here? We've hit on this a little bit, but if you had to look at just the numbers, we've seen a little bit of earnings growth and a little bit of multiple expansion. January 1 this year, we were about 19 times trailing earnings on the S&P 500. So far this year, we've seen, or we were expected to see about 5% earnings growth in the S&P 500, and we've seen a little bit of multiple expansion. Right now, we're just about 20 times trailing earnings on the S&P 500. You take those two numbers, and that kind of gets us to that 7% that we talked about just a moment ago in our return. The earnings recession is over. Again, we're back after seeing 5 quarters of a dip in corporate earnings. Whenever you see kind of an earnings recession in a normal economic expansion, typically that's because of two things. One, a strong dollar. Two, a strong or a weakness in the energy prices, in energy prices. And that's definitely what we saw. That was kind of the recipe there. Small and mid-cap stocks have kind of led the way this year. There's certainly been a lot of volatility in that sector, but as we'll kind of take a look here, you can see that they've done well. Merger and acquisition activity is robust. It's not at record levels. We're not going to surpass what we had probably in 2015. But in terms of deals closing, these deals are probably a little more sticky. There was a lot of inversion deals last year that didn't come to fruition. Pfizer Allergan was one of them. We've seen share buybacks remain important into the market. The level of new share buybacks has certainly declined, but that's certainly still been a catalyst for shares. And then the consumer's back. Housing, auto, and retail are all doing very, very well. So what sectors have kind of led the way this year? Definitely energy. Energy is up 24% this year. Second on the list is industrials, and we've kind of talked about that. Being both of them have really benefited from the election, but energy bottoming earlier this year has also helped. What have been the laggards for the year? Consumer staples, more or less flat, and then healthcare has also kind of been a sore spot this year. I think there was. No matter who won the presidency, whether it was Clinton or Trump, who did win, they are expected to be a change in terms of what goes on in the healthcare in terms of pricing and some other factors there that I think definitely weighed on those shares. What have been the best performers for a while? That's the 5 and the 10 years consumer discretionary. We've seen a lot of multiple expansion in that sector over the past decade. You can see the financial lines are actually the numbers there are good, but they're a little bit out of whack just because there was a REIT spin out earlier this year. So the data has got a little bit of noise to it. Style review, what's worked in style? Small and value. So if anything on the value spectrum has done pretty well this year, and you can see the smaller you get, so small and mid cap have definitely outperformed large cap this year. And we generally like to see small cap value performing well. That's a signal to us that the market is operating a little more normally. So we're happy to see that, and it's had a very good year this year. International markets, when we look at the international markets, I think there's kind of Europe and everything else. And Europe has struggled this year. The currency has certainly, the euro, the pound, the Swiss franc have all struggled versus the dollar. And you've seen that kind of represented here in the performance data. This is all in US data, US dollars. And the economy there is just kind of struggling to get itself going, and they're trying monetary policy to escape it, but we'll see what happens there. Best performing markets are Brazil and Canada. Brazil, honestly, as you can see, the 5 and the 10 year numbers are pretty bleak, and so it was a candidate to become have a great year just because it was rebounding off the bottom. In Canada, most people think that the top sector in Canada is energy, but financial is actually the largest sector in that market, and they're benefiting from the loans they make to the energy companies and things like that. There's less stress on their economy right now, and so they've had a very good year recovering with energy prices. For 5 year numbers, you can see Japan's kind of the top performer there, and Japan's pretty interesting right now. The central bank there, the Bank of Japan, has been an aggressive buyer of stocks. In fact, if you look at the top 10 holdings, or the top 30 companies in Japan, the Bank of Japan is a top 10 holder in almost every single one of those companies. So it would be the equivalent of the Federal Reserve being a top shareholder in Apple, Google, and ExxonMobil. So something kind of interesting to see there. There's certainly potential unwind happening there, but for the meantime, it's been pretty good for returns. Now on to bonds. So we're going to talk about corporate bond performance here. The top line there is the aggregate U.S. bond. So that's the entire bond market. That's corporate bonds, that's treasuries, and that's munis. A quiet year, 2% rate of return. It's certainly been a little bit more volatile than it has in years past. Yield of about 2%. Short-term, intermediate, and long-term corporate bonds all have had positive rates of return, as have high-yield corporate bonds this year. But there has been a pullback in the long-term corporate bond market since the election, and we'll highlight that with some yields. High yield has done particularly well this year for two factors. One, it's pretty correlated with the equity markets. In fact, it's probably got a bit of a higher beta than the equity market. So if equity markets do well, you would expect it to do better. And there's a lot of energy companies that are in the high yield space right now, and a lot of them have just bounced off the bottom. They're clearly not as stressed of a credit as they were in years past, with energy pricing getting better. And so that makes their balance sheets and their ability to repay their debt holders look better. So you've seen a recovery there. On the Treasury bond, this has been relatively quiet. You can see the yields on the far left on the far right are all pretty low. Ranging from sub 3 years of below 90 basis points, 7 to 10 years around 2, and 20-year treasuries are getting you 2.5% roughly. Tips are about 1.6% in yield. If you look at the year-to-date performance, the best performing one is the tips. Inflation's starting to kind of simmer up a little bit, and that is usually a beneficial market on tips. Tips really price off expectations, and so there's an expectation of better or more inflation, and so that kind of helps out the pricing. The muni market has been the most interesting market, I think, out of everything that we follow. And since the election, I would say there's been two contributing factors to their poor performance. You can see that they are posting negative returns. None of the other bonds really had significant negative returns, for the year. They have since the election, but bonds, municipal bonds in particular, got a double whammy. Number one, most people like municipal bonds because they offer tax-exempt interest payments, and so with the way the election shook out is we've seen interest rates surge post-election, and now there's an expectation that tax rates are going to go down. So when you have those two factors, that's a bad recipe for municipal bonds. And this November 2016 will go down as one of probably the 5 worst months in municipal bond history. If you're patient and you've got an appetite for municipal bonds, I think it's a good time to go out and do some buying, because the market is still pretty liquid right now, and there's some opportunities there. And we, generally speaking, when we look back at the second Bush administration and the Reagan administration, when we saw tax cuts, municipal bonds had a similar sell-off, and then they recovered shortly after that. A long-term kind of chart here of the 10-year Treasury rate. We ended up right now we're about 2.4%, we'll call it. That's up about 10 basis points year over year. But you can see, historically speaking, we're still pretty cheap. On a year-to-date chart, you can see we bottomed in July at about 1.37%. So we've added 1 full percent to interest rates, and on a relative comparison, that's pretty steep. And you can see a lot of that move has happened since the election. When it comes to commodities, commodities have had a very good year. Gold, silver, your precious metals are both up year to date, but you can see the 5 and 10-year, 5-year numbers are not that great. When you look at the Brent crude, WTI, nat gas, all of them have you can see clearly bottom off or vaulted off the bottom. The 5 and the 10-year numbers just aren't that great. And then gasoline has been a little more muted in return, but it wasn't quite as bad in years past either. A lot of people like to look at, gold prices, and you can see relative, we aren't anywhere near the peak that we saw during the financial crisis. Gold's at about, between 1175, we'll just call it. It's up about a little more than 10% this year, but we're about 38% lower than we were in 2000 from the peak. So. On some economic data, generally speaking, economic data remains really, really positive. Employment market is strong. We're looking at about 4.6% unemployment rate. That's the lowest since 2007. The trend is still very favorable for jobless claims. Continuous claims continue to kind of hover around 2 million. And I think people will start talking about full employment here probably next year. We're seeing wages starting to move upward, which I think is going to be positive for both inflation, and I think that's going to help kind of grease the wheels of the economy a little bit more. In general, we're seeing record levels out of leading economic indicators. We've got a slide here in a minute that'll kind of go through that, and you can see, generally speaking, those are all positive. There's very good data out of the consumer confidence, housing, autos, and then retail data all look pretty good. Business confidence seems to be improving. We're getting some good readings since the election. Housing markets are closing in on all-time high. Depending on which data set you look at, some indications or some are indicating that we are at all-time highs once again. Others were just a little bit off of that. And then you're seeing record levels of the auto sector. So that's pretty positive. Only thing on the autos that have me a little concerned is when we look at the subprime auto market has been expanding. There's been some recent data that shows that there's some slowing there, but people are taking very long auto loans, which probably means that they won't need a car for quite a while. So you're seeing the amount of 72 and 84-month auto loans representing something between 20 and 25% of all the auto loans issued. So that's a long time to own a car. So when you think about that may be suppressing demand down the road. The Case-Shiller Home Price Index, this is actually just focusing on the composite 20 market. You can see we're still about 9% off the lows. We're up about 3% for the year. Other data sets out of Case-Shiller do indicate that we're either close or beyond prior highs. So the market there is recovering. When you look at the 30-year mortgage rate, you can see, see the spike in interest rates that we've seen this year. Still cheap relative, but we're back to where we were essentially in 2014. We are a Kansas City-based, investment advisor and financial planner, and so we have a lot of companies and a lot of clients who like to know what's going on in the Kansas City market. So just a quick snapshot of some of the larger employers or publicly traded companies here. Sprint, which is headquartered just down the road from us, has had a fantastic year. And I think there's been some renewed optimism that they could do a merger with T-Mobile this year in the near term with the new Trump administration. That could be a positive thing for them. Seaboard is a company that is not very well known, but a very well run company that does a lot in commodities around the world. Had a very, very strong year. Garmin's rebounded. They were one of the laggards in the years past, done pretty well. AMC Entertainment's had a pretty good year as well, up about 35%. They are consolidating the movie industry or the movie theater industry, both here in the United States, and they've started to do that also internationally with a purchase in the UK and Europe. And then we'll look at the the bottom couple companies here, and we'll focus on two. One is Cerner. Cerner is a healthcare software and IT company, and they've struggled since the election. They've seen a pretty strong pullback, post the election. They benefited very much from the Affordable Care Act and some requirements about electronic record keeping, and so there's an opportunity potentially there. And then we have Waddell and Reed, which is down about 34% rounded up, and they've struggled. They've had a lot of asset outflows from their business, but they've also lost a few of their prize portfolio managers over the years. So that's just kind of a quick rundown on some of the larger companies in Kansas City. What is our economic outlook for 2017? So this is kind of our best guess based on the information that we have and kind of how we're positioning things. So expectations right now, between 2.2 and 2.5% for economic growth. And this has been consistent from before the election and after the election. We are in the 90th month of economic expansion, which is a very long economic expansion. The average since World War II is around 58 months. We've had three longer economic expansions, 82, 91, and 2001. And we're very close to getting ahead of the 2001 number. In general, if we had to kind of classify things, I think we have a low to moderate risk of recession in the next 12 to 18 months. But I think that risk is slowly increasing. Don't think it's something we'll be talking about in the next 12 months, but probably something next year this time we'll start to be peaking maybe that there could be a recession in a 2018, 2019 timeframe. The positives, inflation is starting to pick up but remain under control. That's a good thing. That's a good thing for stocks, and we'll talk about that here in a moment. The consumer is in great shape. I think I've probably mentioned that several times already through our discussion. Energy prices are stable. This is really important for the economy in a lot of different ways. We never want to pay too much at the gas pumps, but we want to pay just the right price, and I think we're kind of in that sweet spot here. Employment continues to be a bright spot. Anybody who's really looking for a job is probably able to find something. Hopefully, it's the job that they want. And as I said, we'll probably be talking about peak employment next year, and we should see pretty good growth in the housing market. What are our concerns? I would say the timing of the Fed's interest rates is something that weighs on at least from an equity side or the stock side, something that we're very cautious about. Populism and political uncertainty. With the new administration, I think there's a lot of uncertainty. The Trump, we don't entirely know what his every single policy he's got to a T. I think trade is something that's going to come very much in focus. We are in a global world, and we may look at this as a moment as kind of peak globalization for a period of time. That'll be something that will be interesting to watch play out, because the geopolitical environment is going to be changing, I think, pretty drastically. We're also going to see tax cuts. That's generally a positive thing, I think, for most people. They're pretty excited to pay less in taxes. Hopefully that's good for the government's budget. But in general, tax cuts are generally seen as a good thing for the economy. One thing we always kind of ask ourselves, particularly at this time of year, is this as good as it gets for the U.S. economy? The answer, I think, is probably not. But I think there's probably more upside coming next year. But I have a feeling this time next year we may be looking at ourselves and saying, you know what, this might be as good as it gets for this economic cycle. We mentioned the leading economic indicators before. We kind of use this as a snapshot or a dashboard to say, hey, what's working, what's not working? Are there things to be concerned about here? And generally speaking, things are neutral to positive, with only one area that's kind of worsening. And I think in general you can look at this snapshot and say, hey, everything's pretty good here. And that's kind of how we feel kind of headed into 2017. All right, so we're going to kind of finish up strong here with our equity outlook, and then also get into our fixed income outlook. But I saw this slide at a conference, and I thought it was worth sharing. And so this has been the most hated bull market in history. I don't think anybody will deny that. And there's two quotes here, one from Sir John Templeton, the legendary investor, and one from Liz Ann Saunders, who's Schwab's chief strategist. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. And that's been a very typical kind of philosophy on how to look at kind of any bull market. You look for the mature on optimism, and you look for the euphoric moments to maybe plan a moment of time to get a little more cautious or to change your expectations. With this bull market that Liz Ann Sanders says is this bull market was born on despair, grew on disbelief, is maturing on skepticism, and may die on acceptance. It's definitely the way things kind of have felt. Is we've never really seen any optimism about this market. People have always been looking for an opportunity to get more conservative, and it just kind of keeps moving forward. And so that's kind of a quote that I think is very accurate, probably describing this economic cycle. In terms of where we stand with inflation and kind of price to earnings expectations, because this kind of helps frame our outlook, is we're still in a sweet spot. And so anytime you see kind of a 2 to 3% inflation level, you can expect average PEs about 17.6%, and you can see the range of about 27 to 11 of where the market kind of has always kind of lived. Right now, we're about 16.7 on a forward earnings basis. So we're definitely kind of below average in terms of where we fit on this chart. You can see the higher inflation gets, the lower the PE that we can expect from the market. So if we start to see inflation ticking up, then we might be pulling a little bit from our PE multiples, and hopefully the earnings will make up for that. But that's just kind of something there to kind of show. Something else that's important in terms of performance is how the Fed tightens, and we are expecting a Fed move in early December here of 2016. It would be the second raise since the financial crisis if they do that, and there's probably an opportunity for a few more next year. But the pace of their tightening is very important, and so the pace of their future interest rate increases really have a significant impact on returns. So if we see a fast cycle, which means they raise interest rates at consecutive meetings. We saw them do this in 1967, 80, 87, 94, 99, and 2004. The mean's pretty low, and the medians, you can see, definitely below average for 1 year. When we have a slow interest rate where they take a break between meetings, kind of like what they're doing right now, that's pretty good for stocks. So you can see there's a pretty good return, and then you shouldn't worry too much about Fed, just because the Fed starts raising rates doesn't mean you need to sell stocks right away. You can see that the average return is below average, but not so much so that that's something to be fearful of. In general, when we look at this slide, we kind of use this as a I would say just kind of a dashboard to see where we are on a relative basis, and we use this to kind of price where we expect our future returns or expected returns to be over the next few years. None of these are on a standalone basis or as a whole or a buy or sell signal, but it helps us kind of set our expectations for the next couple of years. Any of these metrics, the Fed model, equity risk premium, are both tied generally to interest rates. We know those are kind of artificially low, so you can kind of don't want to put a lot of weight on them. And then when we look at some of these other metrics, everything is showing that we're either barely valued or slightly expensive. The Shiller Cape is something that people often reference, and it's not a very good timing tool, but it does help us frame future expectations. And I think in general, if we look the next 10 years, we probably want to have lower expected returns for stocks based on the current valuations. No sell-off is imminent probably, but you never do know. But generally speaking, I think over the next few years, we probably ought to expect to see lower than average rates of return. Something else, since we're at all-time highs, every time I hear of something being at a high, an all-time high, or peak pricing, I'm always kind of saying, well, should I be looking for the exits? And the data actually contradicts that thought. And so whenever you look at this, I got this from Ben Carlson, and he writes at a website called A Wealth of Common Sense, and he did a study, and we've actually done some studies here also at Castlebar on the topic. If you look at kind of how stocks move when they hit an all-time high, 1, 3, and 5 years later, the average rates of return look pretty good. You can see the biggest gains and the biggest losses there, so there's certainly downside, but in general, 1 year, if you bought on any single day other than an all-time high, you're probably looking at being higher, having positive rates of return about 2/3 of the time. So you can see that at 74%, if you buy at an all-time high, you have probably a better probability of having a higher rate of return or a positive rate of return than you would if you just bought on any day of the market. And the numbers for 3 and 5 years look pretty similar too. So do not fear all-time highs. That's what I was going to say, is that it's pretty important to look at history sometimes. The one problem is that there are moments in time when you buy at an all-time high, and you do see those drawdowns, and we can see the biggest losses associated with that. So we know that there are drawdown opportunities anytime you're buying at an all-time high, but that's something that we shouldn't necessarily fear. We should maybe use some of the other metrics that we have out there to help identify when it's time to get a little more conservative. So our outlook for stocks, we just hit on the all-time high. We talked about the earnings recession being over. In general, whenever we are in general, I think we are in a late stage of a bull market. Expect more volatility, expect large M&A deals. Those are two hallmarks that we always look for kind of in a later stage bull market. And, that's kind of something that I think we expect to carry on. We do see stocks trading at an elevated level. We felt the same way last year. I would say they're fully valued, but not significantly overvalued. So something we just need to be careful. If earnings growth does not come through as expected next year, we could be in a little bit of a sticky situation. But again, I think we're priced at a level that we can be comfortable owning stocks here. Positives, earnings growth is expected to be in the high teens. I think right now the S&P data set that we use is predicting 20% earnings growth. That's probably a little more optimistic, so I think you probably want to put yourself in the 12 to 15% camp to be conservative. I also think there's some international attractive opportunities internationally. You're just going to be patient there. Concerns, trajectory of a Fed increase, we saw the impact there, and then sentiment is positive but not euphoric. So that's probably a positive here in the short term. But whenever you have significant periods of positive sentiment from individuals or for traders, usually there's a pullback waiting to happen. So that's something that's one bit of concern, is that sentiment seems to be improving since the election, and that that's not a bad thing, but it's something that we're concerned about. So the 4 Make America Great trades again, industrials and infrastructure. They are, I think you've already seen a pretty good bid there. But if the infrastructure plans come to fruition, they're going to continue to benefit. Small cap stocks should benefit here, in the near term. Typically, you don't see them benefit late in a bull market like this. But I think we could see this being a counter trend. Financials should do better. Less regulation, higher interest rates. That's a good recipe for them, and they've been. There's still some pretty good value there, even with the recent move. And then finally, repatriation. It seems like to pay for some of this infrastructure and some of these tax cuts, they want to bring back some of the money from overseas that's held overseas in a one-time kind of repatriation tax. Three things that could happen out of that that could be positive for shareholders. And you can easily pull this list of stocks that have got a lot of cash overseas. Apple, Google, Microsoft are all just a few of them. Is you can see them pay off some of the debt that they've taken on in the last few years, so tidy up their balance sheets. Medium to low probability that'll happen. I think the most likely outcome is you'll see them either do large M&A activity, or you'll see them do stock buybacks. And we like to see companies do high conviction stock buybacks. That's a factor that we really go out for and search for in companies. And so whenever we see this, those are all positives, I think, for stocks in the near term, is that if they do pass this and companies do bring the money back, and this will be a good thing. Our sector bias, financials and energy is kind of where we want to be early next year. Financials should continue to do well. Energy is set up to do pretty good. There's been a big rebound there, so some of the returns have probably been pulled forward for next year, but you're probably good there. And then early in 2016, we're cautious on healthcare. So. Outlook for fixed income, interest rates are headed higher. I think that's something we've been saying for a long time. 3 interest rate increases by the Federal Reserve are probably expected for next year. That's where we stand right now. Bond market remains expensive, but there's some value in the muni bond market. So if you want to look for some municipal bonds, not a bad place to be. You want to have your portfolio, shorter duration in general. And then we are using some preferred stocks. I think they're pretty attractive here after the recent correction to help with cash flow for clients. Those clients who need a little bit more cash coming out of their portfolios, preferred stocks are kind of an interesting way to do so. Our contrarian points. So these are 3 things that we think could, if we had to play a low probability, high payout bet, we might look at these 3 things. So number 1, the dollar rally ends. We've seen the strong dollar take place for a number of years, and if there's probably an opportunity next year that this could play out. If that happens, 2 easy things to do is buy tech stocks. Whenever we see the dollar correct, they generally benefit from that. A lot of their earnings are tied or sold in U.S. dollars, and so it becomes more attractive for people to buy in markets outside the U.S. And then buying international stocks, you get a headwind on the currency there alone, so that's something else that could work for you. Interest rates don't rise as much as expected, or don't increase as much as expected. Generally speaking, I think everybody expects interest rates to be half percent, 2% higher sometime next year, and we are in a relative world though. Is if the rest of the world is staying put, we could really do some damage to our currency if we keep raising interest rates. That'll see a lot more money flow into the U.S. dollar, which could create some secondary impacts that probably aren't positive for us to look at. So that's something else that could happen, and it's maybe tied to the dollar rally as well. And then finally, there's a lot of value in healthcare. Right now, the environment's pretty bad, and there seems to be a lot of hearings, and healthcare companies can almost do no right in the current environment, and that's an opportunity when maybe you want to do some bottom fishing. And while we're not buying actively right now, we're not selling either. And we do have a pretty good list of companies that we look at, and you can get a lot of single-digit companies. Some of them have some definitive issues and some growth issues, but there's some single-digit PE healthcare companies out there that are worth taking a look at. So, if you have any questions, you can get a hold of us in various different ways. You can tweet at me at CastleBarAM. There's our Facebook page. You can look for me on LinkedIn, or you can email me at Andrew@CastleBarAM. Happy to answer any questions you have about this. Have a great new year. Have a happy holiday season, and thank you for listening.